Afternoon, everybody. Welcome back to this conference on our financial stability review anniversary. So it's my particular pleasure to welcome now Sarah Breeden to give the next keynote speech. And as you will know, Sarah was appointed deputy governor for financial stability at the Bank of England around a year ago. And in that capacity, she's also a member of the Monetary Policy Committee and also the Financial Policy Committee. And of course, you've had a very long-standing career at the bank, and we've also interacted many times on many different issues. I remember securitization, I remember the NGFS work, so lots of different topics, and it's really a real pleasure to have you here today. And I don't know what you will be talking about in your keynote, but I hope that you will tell us something about the system-wide stress test. Thank you.
Good afternoon, everyone. It's a pleasure to be here. When John wrote and asked us the Bank of England to be a part of this day, I was really keen to come and give our perspective on these issues. My aim is to start the remarks today with a brief foray into the history of macro-pru policy and what we're trying to achieve through it. Then I'll explain how we think about doing macro-pru in practice at the Bank of England before going on to do as John asked and look ahead to what I see as the next set of challenges. There's actually quite a lot of commonalities with the things that have been said already, so I hope there's some useful lessons for us all. Starting with the history, as you all know well, following the GFC, we recognised in the UK and around the world that focusing solely and separately on price stability and on the resilience of individual firms and markets was not enough to deliver financial stability. Indeed, by focusing only on individual firms, policymakers had unwittingly allowed system-wide financial risks to grow unchecked. These system-wide risks included interconnections between financial institutions that allowed shocks to cascade through the system, as well as the build-up of aggregate debt levels that the economy was unable to support when shocks hit. With that context, there was widespread recognition that a broader approach, macroprudential policy, was needed if we were to ensure the resilience and stability of the system. And a number of changes to the regulatory architecture in the UK and elsewhere were introduced as a result, including the creation of a macroprudential policy regime. Macro-pru policy, therefore, aims to make the financial system as a whole more resilient, to mitigate disruptions in the vital financial services that are necessary for stable economic growth. Microprudential policy, on the other hand, which, let's remember, used to just be prudential policy, that refers to the regulation that aims to make individual financial firms more resilient. At the Bank of England, we have two statutory objectives: price stability and financial stability, both of which are prerequisites for sustainable economic growth. Price stability is well understood. It's even specified in the form of a quantitative target set for us each year by the government. But financial stability is much harder to pin down. It's most commonly understood as the absence of instability. And indeed, its precise definition has been the subject of much debate in policy and academic circles over the years. Let me see if I can. So, how do we define financial stability at the bank? Financial stability, as others said earlier, means the financial system is providing vital services to households and businesses reliably in all states of the world, even when shocks hit. By shocks, we mean both structural or longer lasting shocks like climate change or cyber threats, and cyclical shocks like severe recessions. To maintain financial stability, we have to mitigate externalities where market participants don't consider the impact of their actions on others. For example, a lender might have an incentive to lend more because their lending is secured by an asset, without considering that the borrower might have to quickly sell that asset or other assets to meet the repayments in the event a shock hits. And that has consequences for the prices of assets held by others. And externalities can lead to fire sales, runs on financial institutions, and an amplification of economic shocks. Now, one way to bring about financial stability would be to try to build so much resilience in the system that as a byproduct, very little activity occurs. The previous Chancellor of the Exchequer in the UK, our finance minister, called that outcome the stability of the graveyard. And of course, that wouldn't be optimal because it would directly limit the provision of services and damage the economy, even in the absence of shocks. And so as a result, accountability for our actions, where we consider the costs as well as their benefits, is an important part of the regime that we have in the UK. In addition to avoiding the stability of the graveyard, it's also not our job to ensure all financial services are provided to all users at all times. Instead, rather than expanding provision in the good times, most of our work aims to limit the negative consequences of disruptions in the provision of vital services in bad times. I like to characterize that aim as being to ensure that the system absorbs rather than amplifies the inevitable shocks that we face. For example, by limiting the buildup of total household debt in the mortgage market, we make sure people are well placed to meet their repayments and access further borrowing if needed when a recession hits. Now, we don't want to insure against every possible eventuality. Instead, we want to build resilience to severe but plausible shocks. And that implies that we're left with a degree of vulnerability and risk-taking, and disruptions can still occur. As a result, we also have to stand ready to intervene quickly and effectively when disruptions do occur, to limit their impact on financial stability now and in the future. And of course, as was mentioned earlier, particularly by Stefan, as we go about doing our job, it's essential for us all to remember just how damaging periods of financial instability can be. The global financial crisis in 2008 was estimated to leave the people of the UK with a permanent cost worth around £24,000 per person. That's very good reason both to reduce the probability that significant disruptions to the provision of vital services occur and to limit their impact when they do. So, let me turn now to which services we think of as relevant to financial stability. And here our focus is on the financial services that are relied on by households and businesses and that have a material role in supporting the economy. It means we care about the vital funding, saving, insurance and payment services that supports household and businesses and so economic activity. And we want to make sure that households and businesses can make transactions and manage and take risk. That includes payments, credit cards, mortgages and insurance services for households, as well as corporate financing activity across a range of forms, bank lending, equity and bond markets, leverage lending, private debt, private equity. All of those have an important role in supporting financing in the real economy. And it's also important that we ensure the resilience of government bond, repo and derivative markets, not least given the foundational roles they play in supporting other financial market activity by allowing risk to be managed, other instruments to be priced and money to flow safely around the system. So how do we put this into practice at the bank? The Financial Policy Committee within the bank is responsible for identifying, monitoring and taking action to remove or reduce systemic risks. It sets macroprudential policy, those that relate to the stability of the financial system as a whole, rather than at the level of the individual firm. But our work on financial stability extends also into microprudential regulation and supervision of banks, insurers, and financial markets infrastructure, as well as resolution policy and preparedness and balance sheet operations too. Ensuring that individual institutions are resilient, the job of the micro-pru regulators, is necessary but not sufficient for financial stability. You can't have macro-pru policy without the micro, but micro alone isn't enough. Indeed, in some cases, systemic thinking can lead you to different policy answers than what you'd get from a purely microprudential perspective. Let me offer 3 reasons why. First, the financial firms themselves and their microprudential supervisors will understandably have a more focused perspective centered on the part of the system they engage in and their own objectives. They'll not think about how the services they provide could be substituted and provided by other parts of the system, nor will they consider how their actions impact negatively on other participants in the system. The addition to aggregate household debt from extra secured and apparently safe lending that I mentioned earlier, for example. Second, individual resilience alone can't ensure that the collective actions of firms in stress do not lead to outcomes that pose risk to financial stability. Indeed, firms might take actions to ensure their own stability with knock-on consequences for the system as a whole. Think about individual banks deciding not to lend in a stress and in so doing, collectively worsening an economic downturn. And then third, in some cases, higher resilience for individual institutions might lead to new or different systemic risk if risk then moves to other parts of the system that are less able or equipped to manage it. You will know that the provision of corporate finance has migrated from banks to markets since the crisis, and you could call that whack-a-mole risk. Oops. Let me go back. Sorry about that. Given the wide range of potential vulnerabilities in the system and the large policy toolkit available to macroprudential regulators like the FPC, we have to be deliberate about where, when, and how we take action, including through working in concert with other regulators in the UK and around the world. The important but less interventionist action we can take is the one that's the subject of the debate we've had today, all about raising awareness of risks amongst financial market participants by communicating publicly our views on the risks and vulnerabilities in the financial system. That's on the left of the chart. And then at the other end of the spectrum, and this goes to the cohesion point, how does what we do, how does what we say, and how do what we do, does what we do cohere? At the other end of the spectrum, we can make binding changes to regulation by recommending or directing that the microprudential regulators take action in certain areas. So how do we decide which of these actions is needed? First, we have to take action where microprudential regulation alone has not adequately addressed systemic risks. In many instances, building the resilience of individual firms, the role of micro-pru policy will build the resilience of the system. But in some instances, macro-pru policy has to build more resilience than microprudential policy otherwise might. That occurred in the UK with LDI funds, given the correlated, concentrated nature of their positions, and which meant that when stress hit, selling pressure was much greater than normal, and for which, therefore, greater resilience was required. In other instances, macroprudential policy has to intervene to lean against the defensive actions that build individual resilience that might otherwise weaken the system as a whole. The FPC can release the UK countercyclical capital buffer in downturns and so support lending that might otherwise fall for unwarranted reasons. And in all those examples, a macro-pru perspective on micro-pru regulation is necessary to manage risk to the system. The second thing we have to do is to remain focused on the biggest risks to the provision of services, not a laundry list, the biggest risks. And how might we do that in practice? Here, stress testing is an established way of sizing risks, and the bank is evolving its stress testing framework in a number of ways, doing our bit to make stress testing great again, as John said. And I'll talk about our system-wide exploratory scenario in a minute, given the important perspective that gives us in taking into account systemic risk arising from amplification and feedback channels and interconnectedness. But we're also taking stock of our framework for concurrent bank stress testing to embed the adaptability it's shown in recent years and allow us to make best use of it to reflect the risk environment. And importantly, too, where banks went first, others have now followed, as well as concurrent stress tests of the banking system. We conduct stress tests of insurance and CCP sectors too. Third, we have continually to adapt to the changing shape of the financial system. In the early years of the macroprudential regime, almost all of our policy recommendations focused on banks. Since then, and reflecting the increase that we've seen in bank resilience and the structural shift in activity away towards non-banks, our recommendations have shifted away from banks to non-banks, notwithstanding the greater difficulties in identifying risks in that more complex ecosystem. And we've had a close eye on operational resilience issues too. And then fourth and finally, as we go about choosing how to act here, macroprudential authorities should be pragmatic and creative about where they can make a difference. I was struck by Stefan's sentiment of learning by doing and just do it. In some cases, the most effective way to change behavior may be by publicly communicating with market participants, indeed privately communicating with them. But as we do so, my take is that we must be deliberate and targeted, focusing our public statements on where we need to get a particular message to market participants to encourage behavior changes. We found, for example, that our Brexit checklist encouraged others to take action to reduce risks associated with the UK's departure from the European Union. If that's how we think about financial stability generally, where are some of the current challenges we're grappling with? As you all know, we've experienced a series of major shocks in recent years, including the impact of the COVID pandemic, Russia's invasion of Ukraine, banking stress in spring 23, stresses in market-based finance, including the dash for cash in 2020, the Archegos family office failure in 21, the liability-driven investment crisis in the UK in 2022, and recent operational issues affecting the financial sector, such as the one resulting from an outage at the software provider CrowdStrike earlier this year. Now, these events have been varied in source and type. Some have risen within the financial system, like SVB, others outside it, like wars. Some have been sourced in the banking system, like Credit Suisse, others in markets like LDI. And some have been technological or operational CrowdStrike, while others have been financial Archegos. And some of the hardest to manage have involved both operational and financial issues at the same time. Think of the pandemic or the LDI episode. when what's expected of our operations has been stretched at precisely the time when we need them to deliver if we are to manage our financial risks. And I'd also add that it's rare, perhaps non-existent, that these events have been domestically focused in source or in impact. So my main reflection on all of the examples I've listed is that while the hardy risk management perennials for individual firms of leveraged liquidity risk and poor operational risk management have often been core to a shock, its concentrations, correlations, interconnections, and opacity that have led to wider systemic risks. These issues are therefore the ones where I think macroprudential authorities should focus. It's our job to understand how interconnected market players are and to consider how risks might cascade from one market to another. It's our job to think about whether services might be substitutable across players or markets. It's our job to find the concentrated and correlated positions. And it's our job to look in dark corners where opacity means that risks are unlikely to be well managed. Increasingly, we've seen these issues arise in market rather than bank-based finance. And I do want to be clear that the provision of finance by non-banks as well as banks should be good news, right? Having two sources of finance provides welcome diversification and substitutability. In addition, much of market-based finance can support system-wide risk management by passing losses back to investors rather than having them sit on intermediary balance sheets whose ability to provide financial services to the economy is therefore reduced. But we do need market-based finance to be resilient so that it can absorb and not amplify shocks, and there remains work still to do here. I have in mind in particular the concentrated correlated positions I referred to earlier, where individual actions to sell or to delever as shocks occur seem rational in isolation, but bring a collective action that weakens other firms, creates and transmits stress through markets, and ultimately risks disrupting finance to the real economy. Now, this isn't just an issue in principle, it's one we've seen in practice and one where central banks have needed to intervene to limit wider stress. If we're to avoid the need for that sort of issue happening again, we need creative system-wide thinking and to build resilience to system-wide risks. So how can we all, whether market participants or authorities, practically build resilient and sustainable market-based finance? First, we must stress test in the good times so that we can take action in advance of actual stress arising. As the Scouts would say, be prepared, and I'll come back to that. Second, we should think about sources of stress broadly, scan the horizon, see what's changing, and think about how those trends might matter for the risks being run in the financial system. We must not just fight the last war. Third, and for me, most importantly, as we think about stress, do not focus solely on firms' own actions. We need to think about what everyone else will be doing in those circumstances too. Who else will be selling? What will market capacity and funding options look like? How might stress in one market cascade to another because counterparties are active in both? And we must have a particular focus on wrong way risk and other places where correlations that usually hold are likely to break down. Which brings me to the Bank of England's system-wide exploratory scenario exercise. Now this, which we call the SWES, is something that we've been working on over the past year. It'll be published next Friday. And it's a novel exercise that aims to shed further light on the resilience of market-based finance. For a long time, central banks and academics have spoken about the importance of understanding behaviors, feedback loops, and interconnections in assessing financial stability risk. but we've struggled to run exercises that quantitatively explore these dynamics at a system-wide level in advance of a shock occurring. And the SWES is the Bank of England's first attempt to do that. It focuses on markets that are core to UK financial stability, the markets for government and corporate bonds, repo markets for these assets, and the associated derivative markets such as interest rates, cross-currency, and inflation swaps. As the slide shows, we've asked many different types of institutions that are active in these markets to participate in the exercise. There are banks, insurers, CCPs, asset managers, hedge funds, pension funds, more than 50 in total. And those participants have been asked to consider how they would behave in a hypothetical market shock with price moves that are faster, wider ranging, and more persistent than observed both in the March 2020 dash for cash and the UK's 2022 LDI crisis. Again, as the picture shows, we're analysing how those behaviours interact and how they cascade across markets to better understand the system-wide impact of the shock. What happens as liquidity is redistributed around the system? Who gets financed in an environment of heightened counterparty credit risk? Who looks to sell assets, etc.? And we've conducted the SWES in 2 rounds, so we can add up individual firm responses, buyers and sellers of assets, providers and users of liquidity, to judge how system-wide dynamics might add to stress. And indeed, it's system-wide analysis like this that helps firms to understand their dependencies on other actions, and so whether their approach to risk management in theory will stand up to stress in practice. And I think of this as a global public good. As I said, we'll publish our results next week, but I can tell you now that they show that a significant and rapid shock to global rates and credit spreads triggers significant liquidity distribution around the system, which combines with other constraints leading to some non-bank financial institutions having to recapitalize or deleverage rapidly. Intermediaries have limited appetite to take on risk in some markets, resulting in some core UK markets coming under pressure, with conditions in the repo market tightening, as well as selling pressure in the corporate bond market. Now, we'll be happy to return to present the detailed findings once the SWES is published, but suffice it to say, I'd encourage all participants and all authorities to think about how similar analysis could be used in their jurisdictions. I wanted next to spend a bit of time talking about how we can seize potential opportunities to boost innovation in payments and how we can do so in a way that supports and doesn't undermine financial stability. Money and payments have been no stranger to technological innovation over many centuries, from coins to paper notes to electronic money, but the pace, breadth and depth of technological change we see now suggests even more radical change may be ahead of us. Indeed, we might be on the cusp of widespread, more fundamental technological change, an opportunity to have cars and not just faster horses, as my colleague Sasha Mills is going to describe in a speech today. Technologies that are loosely grouped under the broad heading of tokenization, distributed ledger technology, atomic settlement, programmability, as pioneered in crypto asset markets. These technologies have the potential to offer greater efficiency, lower risk, and increased functionality for real-world retail and wholesale payments. That innovation, of course, matters hugely for our role in maintaining monetary and financial stability, but has the potential to offer significant benefits for customers and businesses, economic activity and growth. Let me give you an example. In retail payments, the high volume, low value payments made between households and businesses, our experiments with the private sector and the London Centre of the BIS Innovation Hub have already shown how use cases for these technologies can embed payments more deeply, automatically, and efficiently into our increasingly digital lives. That has the potential to solve the issue of late payments for the provision of goods and services by small businesses, and where research suggests that the foregone revenues as a result of the consequent cash flow challenges represent a significant hit, not just to the businesses, but to economic growth too. Such technologies also offer the opportunity to enhance wholesale payment and settlement, the low volume, high value activity between financial and corporate institutions, including interbank payments and the payments that settle financial market activity. These technologies can facilitate the monetization of assets that are currently not able to be easily turned into cash. And they can create that liquidity for short periods of time. And if that's managed well, that's good for financial stability. To manage it well, we need to look ahead to identify the changes needed in our role, both as provider of infrastructure and as regulator of the financial system. Let me offer 3 examples. First, it's clear that some of these technologies can reduce risks in the system, collapsing the myriad of post-trade clearing and settlement activities and intermediaries into a potentially instantaneous smart contract could reduce or even remove counterparty credit and settlement risks. But it brings new challenges. The ability to net transactions before settlement is reduced. That brings new liquidity risks to manage. And we need to ensure finality of settlement in a distributed ledger technology world, issues that we're exploring in the Bank of England's Digital Securities Sandbox, which is now live. Second, as the central bank, we issue the safest form of money in the economy, and that money plays a crucial foundational role for monetary and financial stability. As technology advances, therefore, we need to ensure that we provide central bank money and payments infrastructure with the requisite functionality so that our role as anchor of confidence in other types of money in the economy is not eclipsed, and to make sure that there isn't a shift of wholesale activity into private forms of money with the potential for financial stability risks that such a move would bring. And then third, a regulated financial system that isn't delivering at the frontier in terms of outcomes for the real economy and financial markets is vulnerable to new players growing quickly outside the regulatory perimeter. They might quickly get to systemic scale and in so doing create risks that are hard retrospectively to address, a phenomenon that we've seen as technological innovation has hit other sectors of the economy. And all of that, I think, underlines the importance of being forward-looking if we're to manage the potential for financial stability risks from technological innovation in money and payments, trust in which really is the foundation of financial stability. Let me turn finally to work that we've also been doing on the increasing power and use of artificial intelligence, in particular generative AI, and what that might mean for financial stability, and so how we should respond. I start from the premise that Gen AI models have distinctive features compared to other modeling technology. They can learn and evolve autonomously and at speed, based on a broad range of data with outputs that aren't always interpretable or explainable, and objectives that may be neither completely clear nor fully aligned with society's ultimate goals. AI is expected to bring considerable potential benefits for productivity and growth in the financial sector and the rest of the economy. But for the financial sector to harness those benefits, we must have policy frameworks that are designed to manage any risks to financial stability that come with them. Economic stability underpins growth and prosperity, and it would be self-defeating to allow AI to undermine it. Now, the safe use of AI in the financial system must, of course, start with the safe use of AI by individual firms. On that, and despite those unique features I mentioned earlier, financial regulators, including in the UK, have tended to adopt a technology agnostic approach in the way we seek to address AI's risks. In other words, We've expected firms to meet our existing rules on data management, model risk management, governance, operational resilience, regardless of the technology they're using. Now, that's a sensible place to start. A tech-agnostic future, a tech-agnostic approach future-proofs regulatory frameworks. It focuses on what matters, the outcomes, and does not require us to have perfect foresight on how technology will evolve to deliver them. And today, that tech-agnostic approach seems to have worked pretty well for AI and machine learning. Firms have been quite cautious in the way they've deployed AI in their operations. In our engagement with them, including a discussion paper we published in 2022, many respondents thought there were no regulatory barriers to the safe and responsible adoption of AI in the UK. That's good news. It means our regulation is not impeding the growth and productivity benefits that the technology can bring. But the question we have to keep asking ourselves, though, as AI models get ever more powerful and ever more widely adopted in a wider range of use cases, is whether we can continue to rely on existing regulatory frameworks, since these were not built to contemplate autonomous evolving models with potential for decision-making capabilities. In particular, does a tech-agnostic approach continue sufficiently to mitigate the risks, or does AI necessitate a different approach? And given that AI is going to be used all across the economy, not just in finance, how might our expectations for the development of models in finance sit alongside those models deployed in other industries? And there are a few areas where we are particularly keen to explore on both micro and macroprudential grounds. For example, when thinking about firms' model risk management, are existing regulatory and supervisory frameworks sufficient to ensure firms understand what their models are doing as they evolve autonomously? And are firms able to constrain it where necessary? As I said, we had a discussion paper, and the respondents to that highlighted the risk that the model risk management principles we set out for banks, which cover quantitative modeling in general, not just AI, those respondents thought they might not be sufficient to ensure model users fully understand the third-party models they're deploying. Limited explainability of AI models is a particular focus, and so as regulators, we need to consider further what explainability means in the context of Gen AI, what controls we should expect firms to have, and what that means for our regulatory and supervisory frameworks. Further guidelines and guardrails might well be needed. Feedback to our discussion paper also noted the lack of clear, widely applicable standards around the data which AI models are trained on. So can we do more to ensure that firms are training AI models on high quality, unbiased input data, that they can, to a reasonable degree, trace through how the model's behavior is responding to changes in particular aspects of that training data, and can firms understand where the model is particularly dependent on certain segments of that data? And finally, on governance, a striking finding in our latest survey is that only a third of respondents described themselves as having a complete understanding of the AI technologies they had implemented in their firms. Now, on one level, it's not surprising it isn't at 100%. This is a fast evolving technology. There's some element of learning by doing, just like with our financial stability analysis. But as firms increasingly consider use of AI in higher impact areas of their business, credit risk assessment, capital management, algorithmic trading, I think we should expect a stronger, more rigorous degree of oversight and challenge by their management and boards, given AI's autonomy, dynamism, and lack of explainability. In addition to ensuring that the micropru regime delivers safe use of AI by firms as a necessary foundation for financial stability, we need also to consider the macroprudential aspects. In particular, we should be alive to the possible need to adjust our regulatory perimeters should the financial system become more dependent on shared AI technology and infrastructure systems? To return to my earlier framing, there could be concentrations that matter for financial stability there. And in addition, our stress testing frameworks could usefully evolve in time to assess whether AI models used in the front line of firms' businesses could interact with each other in ways that are hard to predict ex ante. For example, when used for trading, could we see sophisticated forms of manipulation or more crowded trades in normal times that exacerbate market volatility in stress? Let me conclude. I describe our work on financial stability as making sure the financial system provides vital services to households and businesses reliably in all states of the world, even when shocks hit. As policymakers, we have to take action to identify risks and build resilience in advance if we're to help the system deal with those shocks. As we look ahead, we should prioritize building our understanding of and taking action to mitigate, where appropriate, the financial stability risks that relate to the resilience of market-based finance. And we need to focus on how we can best support innovation in retail and wholesale payments and other new technologies like generative AI in a way that supports rather than undermines financial stability. And then finally, as we do so, we should have an eye to the concentrated, correlated, connected, and opaque risks, whether financial or operational, because history suggests these are often the source of disruption. And let's do system-wide stress testing in the good times to make sure we're prepared for the bad times. Surveillance of that kind means we'll be better able to distinguish between the false alarms and the missing crises before they crystallize. And that is a very good thing. Thank you.